All right, I think we're going to go ahead and get started. I see there's a few people still connecting to audio, but wanted to thank you for joining us for the Fort Wayne Ag Outlook seminar. We're excited to have you with us today. We wish it could be in person, but hopefully in the near future, we can do a meeting in person next year. Today we've got Howard Halderman joining us to discuss land values, and Bill Needler with First Merchants, and he'll be discussing ag lending trends and tools, and you'll be asking questions on how to do your balance sheet correctly and those exciting things. But with that, a couple housekeeping things. If you have any questions at any time, feel free to type them into the chat, and you can send them right to me, Nolan Sampson, and I will make sure that that gets to the correct speaker. And I think Bill may have a question and answer session at the end of his presentation. So with that, I will let Howard take it away and enjoy the seminar.
Good morning, everyone. Welcome today on behalf of Halderman Farm Management. We also want to thank the First Merchants Bank for their contribution to participate in this and making this seminar possible this morning. I want to introduce the Halderman Real Estate Services representatives that are helping put this together for you today. I'll start with the elder statesman of the group. That would be Rick Johnlows. Rick is an area representative for Halderman. He's been around with us since 1983, doing real estate sales, acquisitions, professional farm management, and appraisals, primarily in the Fort Wayne to Muncie region, and he lives in Wells County near Bluffton, Indiana. John Rosine is our other younger, middle-aged area representative. He's been with the Halderman Company since 1999. He does both private and auction real estate sales, certified appraisals, and professional farm management. His focus is northeastern Indiana, so you think kind of north of Fort Wayne, where Rick is south of Fort Wayne. And he lives and has an office in North Manchester, Indiana. And then finally, I want to introduce Neil Woolheater. Neil's been with us since 2006. He is primarily in the Northeast Indiana area, up in the Kendallville, Noble County area where his office is located, and doing real estate services for us. So those are your three representatives that we're working with this morning. And I'm going to take you through a presentation on farmland values and rental trends as we see them today. This information is pretty real time. And so I think you'll enjoy what we've got to share. Nolan, help me out and make sure you're seeing what you're supposed to be seeing. Fortunately, I cannot. Yeah, unfortunately, I can't do that because of the.
I can see the slideshow, so you're good to go.
All right, so 2021, a year of surprises. And I think it was a year of surprises certainly in 2020. And I think we've already seen in a couple of months here in 2021, even more surprises in the farmland marketplace. Who is Halderman? Well, Halderman was started 91 years ago by the man in the middle of this slide, and that's my grandfather, Howard Halderman. And today we're based out of Wabash, Indiana, and provide services in 19 different states, from farm management, property management, to real estate sales, and to farm appraisals. And basically we represent landowners. Anybody who owns a farm might need our services, whether it be management, whether it be sales or appraisal. At some point in time in your life of owning that farm property, we probably can offer some sort of assistance or guidance as you navigate your farmland ownership and enjoy it. And we've been doing that for 3 generations. You can kind of see the scale of our business today, managing almost 700 farms in 19 states, as I said earlier, doing well over 100 million in sales and over 900 appraisals annually. That was a new record set last year with the lower interest rate environment. We were founded in 1930. I'm 3rd generation owner of the companies. Average tenure of our staff is greater than 20 years. And so as I talked about Rick and John and Neil, you kind of got a feel for how we come up with that average tenure of 20 years. What that means is when you hire a Halderman representative, you get somebody in that area, be it Neil or John or Rick, that has been working in that area for a long period of time. They know it very well. They know the farmers, they know the land, they know the productivity capabilities. And so as a result, you really get an expert opinion when you contact the Halderman companies. And then it just gives you an idea of the 19 states that we're working in. So not only do we see a majority of our business is going to be here in Indiana, Ohio, and Michigan and Illinois, so corn and soybeans we know really well, but we also see crops ranging from almonds out in California all the way to blueberries in Southeast Georgia. So got questions on any of those kind of crops, we can certainly try to answer them. But our goal today is really to talk about farmland in Northeast Indiana. And the values are certainly strengthening today. And that might be a surprise to people as they think about the world that we've lived in for the last 12 months, the pandemic, the crash in the stock market, the rebound in the stock market, low interest rates, and all those different dynamics. Agriculture weathered all of that really well. First of all, we were deemed an essential business, so we were able to continue doing what we were doing as normal. That's not a surprise. But I think it was a surprise as maybe that the farmland market did not change really at all throughout the pandemic, and then actually saw an increase as we got later in last year. So let's talk about some of the reasons for that. First of all, there continues to be this theme of no outside drivers of farmland sales. And this started back in 2013 all the way through today. So you might ask, well, what do you mean by that? And an outside driver might be a tax law change or the threat of a tax law change. And if you go back to 2012, that if you had the ability to search newspapers back then, you'd see a tremendous number of farmland sale ads in the second half of 2012. And at one point, we were literally selling 3 to 4 farms every week from August through December. Why? Because it was pretty well known that President Obama would be reelected, and it was anticipated that Congress would turn Democratic at the time. And therefore, the fear was capital gains taxes were going to go up. Now, you and I both know capital gains taxes never really did go up. They never changed. But just that fear became an outside driver, and a lot of people who'd been thinking about maybe selling in the next 1 to 2 years said, you know what, I want to sell here in 2012, prices are high, I know the capital gains tax rate, and I want to cash in my chips now so that I have that known tax rate. And so that's what I mean by an outside driver. And really since 2013, we have not experienced any of those. No major tax law changes. Certainly we've had a new farm bill in the interim, but that farm bill didn't really serve as an outside driver. So that has led to the number of farmland tracts on the market has remained below normal, especially larger tracts. Yes, you'll see a few around the country that are being advertised, but generally speaking, there's just very little for sale. And I look at all the farmland newspapers on a weekly basis, talk to other brokers around the country, and this is a consistent theme across the Corn Belt that the number of sales remains below normal. Cropland values were stable for the last 5 years. And so what I mean by that is about 2014, 2015 through 2020, they were very stable, traded in a very narrow range. Now they're moving up. And a lot of that was driven in the third to fourth quarter of 2020. Recreational timber and rural residential values. Northeast Indiana has a lot of this kind of property. And those values are all higher due to lower interest rates and then also the COVID dynamics. And that has a couple of things. One is the work from home initiative. All of a sudden, you've got a lot of people who realize they don't have to go to the office to do what they do. And so maybe they prefer to live on a more recreational or rural property. And so they've looked at buying out in the country. Likewise, some people just have a fear of living in high dense population communities like maybe downtown Fort Wayne or Indianapolis, Chicago, and they look to get out of those environments and be in more of a rural setting. So those values have been up, largely due, no different really than the housing market, low interest rates and pandemic dynamics. So we're going to start with just some surveys, information that I gleaned from the marketplace. This is from the Federal Reserve Bank of Chicago. And we had a question in yesterday's seminar, so I want to make this clear. This is a survey of FDIC insured ag bankers. So they're asking these ag bankers in the states that you see listed there to the right, that makes up the 7th district, so the 3 I states, Michigan and Wisconsin. What did you see farmland values do in the last quarter? And then what did they do in the last year? And so if you just focus on the year over year change from December of 19 to December of 20, we see a pretty big increase in farmland values. Indiana, gosh, they say we went up 9% last year. Illinois up 6%. The whole district went up 6%. That's a pretty big increase in farmland values year over year. And a lot of that was due to the fourth quarter. Now, you know, in Indiana, it showed the fourth quarter was only up 2%, suggesting that a lot of our increase was prior to that. But I think in general, the big increase was probably third to fourth quarter because that's when commodity prices and yields were well known. So then we go to the Purdue chart. And on the Purdue chart, this is a survey that's done in June. So this data is a little past, you know, a little history at this point. But you can notice that when did the pandemic hit? March, right? And then we shut down all of March and April, started to reopen a little bit in May and more so in June. So you think about doing a survey of farm managers, real estate appraisers, and real estate brokers and ag bankers here in Indiana. You do that survey in early June, and yet they still all said, all classes from below, you know, below average productivity all the way to high productivity, all went up in value over the 2019 to 2020 years. And so I think that really shows some of that strength and limited supply of farms available that drove those values a little bit higher, even in June, let alone what occurred the rest of the year. So I'm going to take you through a time series here, so to speak, from 2013 through 2021. And this is a way we analyze farm sales. These are sales only in Indiana. And that's because the productivity index for soils here in Indiana is consistent. Once you cross the line into Ohio or Michigan, it is different for what would be similar soil types. So you really only use this within a state. And so we analyze our sales in the state of Indiana in this case, and we look at how many dollars per acre they sell for, let's say $8,000 an acre. And then we divide that by the productivity index for the soils that exist on that farm. And you can see productivity indexes here in Indiana anywhere, generally speaking, from 110 to 180. 180 would be a really good farm, probably produces 220 bushel corn year in and year out. So these productivity indexes will lag actual production because they were calculated in past years and hybrid genetics and things continue to outpace it. But it gives us a great way to look at one farm and compare it to another farm based upon the productivity index of the soils. And so we basically divide that 8,000 by, let's say, 135 bushels per acre of corn productivity index, and we come up with so many dollars per corn bushel of productivity index. So that's a really long explanation. But at the end of the day, what I want to talk about are these trends. In 2013, that was the peak of the farmland market ever. And we traded at above $60 per corn bushel of productivity index. So if you had a farm at 135 bushels and you took it times $62 per bushel, that would be indicative of the value back in 2013. Now let's look at what happened in 2014. This is where the downtrend started. Commodity prices began to erode, and as a result, land values went down and rents. And so you saw it start in the low 60s and end in the mid 50s. 2015 really was the bigger year of decline. Now, again, these are just our sales. So we started the year back above 60, whether that was reality or just those specific sales, hard to say. But the point is, look at the trend line down, and we end the year at about $50. So what was 62 has dropped to 50. That's about a 15-ish% decline in land values. And that's when the big decline occurred. 2016, now, remember I said earlier, 5 years of consistent, steady land values. And this really depicts it because you can look at our sales in 2016 in that red line, the linear average is right at $49. In 2017, it starts at 48 and ends at 52. Again, hovering right around $50. And then 2018, all the way across at $49 the whole year. Now, a lot of variability you see in each of these charts. That's because every farm's unique. Every farm is different. And it's really hard to predict where it's going to sell. One of the values of taking a farm, let's say, to auction is that you find those specific nuances in value for each individual farm. It also means that you can't use maybe a general appraisal tool because every farm is different. you could take this WAPI calculation, for example, and say, well, Halderman says the dollars per WAPI bushel are 49, and I'm just going to take that times my WAPI score and sell my farm at that. Well, based on this chart, you could be dramatically wrong one side or the other. Here's 2019. Now we start the year in 2019 a little sluggish in the mid 40s. We end all the way up above 50. Really a pretty good finish to 2019, where yields ended up much better than what we thought they would be earlier in the year due to the prevent plant, and that fall season really helped us out there from a production standpoint. 2020, again, starts below 50, but ends back up in the mid 50s. And this really shows that 9% increase. You know, some of that maybe occurred in 19, some of it also occurred obviously in 2020. And then we look at 2021, where we started the year well below 50. Now, this is a limited number of sales, because one of the things Pat does when he does this is he tries to pick farms that are a high percentage cropland and are not influenced by other factors. And so that really limits the number of sales that might be included in this. But the point is, we're back up to almost $55 again. So for the last couple of years, we've been above that $50 flatline number, and indicative of the strength that we see out in the farmland marketplace. And I don't think, I'll go back to this, I don't think two sales that we did last week were included. One might be thrown out. It was down at the city, Connorsville, Indiana, in East Central Indiana. That farm brought $12,000 an acre. That was double what the city of Connorsville, who was the seller, expected. Now, you might say, well, Howard, it was only a mile from town. I think there was some development value in that. Maybe. But I would point out that the city of Connorsville was the seller. Why would the city sell that 58 acres if they had some thought that it might be developed for some use in the future? So I look at it and say, yes, it probably had some value because it's on State Road 1, a mile from town. That might be more than farmland, but that much more? That's $92 per productivity index point. So it seems like an anomaly to me, but at the same time, it kind of was a farmland transaction. Then we had one that was in Miami County on Wednesday night, 700 acres. That was a classic one that will go on this chart, and it traded at about $60 per productivity index point. So again, strength in the marketplace. So we'll talk about those here in a second. So here's that flat 5-year time period from 2016 to 2020, and that spike up in 2020 late in the year really starts to show the maybe that red line is moving upward a little bit now. And here's another way to look at it from a bar graph standpoint, and it shows you just a different dynamic where you see the decline in 14 and 15, the steadiness for the next 5 years. And I expect 2020 to be an uptick for sure. 2021, I'm sorry. So here are some sales that we've done since last November. And these are mostly auction on this slide. And you can see all of the, right there, we've got the acres, the total dollars, the dollar per acre, and then the dollar per productivity index. And you can see all of them are above 50, some in the 60s. There's one at 42 up in St. Joe County. But everything else was well above our average the last 5 years. And this is around the state of Indiana. Now here's a couple of more, adding in the two that I mentioned from last week, and then some private transactions that we've conducted as well. Just continuing to show that strength well above $50 per productivity index point. So certainly the market is strengthening based upon not only the survey results from the ag bankers and the survey results from the Indiana Society of Farm Managers and Rural Appraisers, but also real sales transactions. If you want to stay up to the minute on what Halderman is doing in terms of sales, both private as well as auctions, you can download our app that's available on Google or Apple, and just go in there. It's free, and download the app, and then you can see what's upcoming. You can look at a map and see where the farms are located. You can actually, I think, go in there and put in your current location, and it'll show you listings that might be around you at that point in time. So here's another thing that I did. Now, this is an internal survey, and I commented before I started that this is some really fresh information. I asked our staff a week ago or 2 weeks ago, as of March 1st, 2021, what happened in farmland value changes in the last 6 months. And you can see from September to March, here was their opinion. They thought that the best cropland in their area went up anywhere from 5 to 20% in that 6-month time period. Average cropland up about the same. Woodland, rural building sites, and rural residences, all in very positive territory. So you think back to my first slide on farmland values, and we talked about cropland values strengthening, but also those other timber, woodlands, recreational land strengthening. You see all of that indicated here. Livestock still struggles. That's due to some of the dairy challenges we see, as well as on the hog side. And of course, feed is not inexpensive when you're talking about higher corn and soybean prices. So this is really real-time information from our staff, feeling that strength coming through in the marketplace. So we could probably stop now. Basically, Howard's concluding the farmland market is up and it's going to continue up, and that really would be the theme that you need to get from today. We are going to talk about some indicators and where things might go in the future. I always get a question, who are buyers today? You know, the assumption is that we're selling farms to big institutional investors from the coasts or across the world, and that's not really the case. The majority of the farmland buyers continue to be farmers. That would be the blue part of this, and you can see about every year it's a majority of the farms we sell are farm buyers. 60-40 in 2020 is that split. But here in a second, we'll also talk about what our staff's kind of perceives their marketplace to be. But here's another question I asked them: are seeing more or less sales than in previous years? And you can see 80% of our staff said less sales. So we talked about that limited supply earlier. This is really evidence of that, where all the representatives from Indiana, Ohio, and Michigan are saying, yeah, 80% of us are in agreement that there are fewer farms for sale out there. Now, I talked about this. This really mimics what our sales results were. I asked them, in your marketplace, who's the predominant buyer? Regardless of whether Halderman handles the sale or not, you know, who's the predominant buyer of farmland? And you can see it's about a 60-40 split, as we talked about in our actual sales results. I think that farmland investor creeps back up as a bigger number when commodity prices and cash returns improve, which is certainly the time period we're in now. Now, let's talk a little bit about the Purdue Ag Barometer. This is a survey of 400 producers across the United States. It's not just Indiana. So Purdue's doing this in conjunction with the CME group out of Chicago. And they go out and talk to these 400 producers on a monthly basis, and they rotate those producers. And they just ask them a variety of questions, but this is the main headline question. How do you feel about the agriculture industry today? And average is 100. If I feel average about it, I'm going to score that 100. If I feel the best I could feel, it would be 200. And if I feel the worst I could feel, it would be 0. And you can see that way back in March, April of last year, it was down around 100. You see that very precipitous drop. We were at 168 in February, dropped down below 100 in March, all due to the pandemic. So certainly it had an impact on outlook at that point in time. But pretty quickly we rebounded. We were looking at pretty good production throughout the summer, combined with improving prices all throughout this last half of the year, and government support payments. And so really today, you know, at 165 here in February of 2021, we're right back where we were a year ago, and at a level that I would call very optimistic as these 400 producers are looking at current times. So let's talk a little bit about farmland debt. That's always a question of metrics out there, and is that a concerning level or not? And if you look at inflation adjusted debt in total, we are right back where we were in 1980. Now in real term or nominal terms, you would be looking at a number that's exponentially higher. But the reality is that inflation adjusted, we're back right where we were in 1980. More real estate debt, more farm mortgages, and less on the operating or machinery side than what we were in 1980. But still in total debt, we're right back at that number. So that's a worry, right? So let's compare that to the interest expense though. So the blue line on this chart is the total amount of debt, which looks just like the previous chart. But the orange or the brown line is the one I want you to look at here. interest rates are markedly less than they were in 1980. In fact, I had dinner last night. My father-in-law was commenting that he assumed his house mortgage from the seller in 1980 at 16% on a house mortgage. So just to show you what the interest rates were back at that time, I give that example. Well, we're looking at, a fraction of that, maybe 25% of that number today. And so your interest expenses for operating lines, for mortgages are a lot less. So when you start to do your budget for your farm operation, the interest expense is significantly less. And that, I think, mutes the amount of debt and the impact of that debt that exists. Here's the farm sector solvency ratios as projected for 2021. You can see they're still well within a very safe range. I was reminded of some comment last week from an ag lender said, well, you got to keep in mind that those are all low ratios because the denominator, the farmland value, is so high. True, but it is reality. We sell farms. We sell them at those values. It's not a made up on paper number. And so the debt to equity and debt to asset ratios remain at a very safe level and well below what they were in 1980. Now, another way to look at debt is debt to income. And maybe this is a little more representative of things to come as opposed to where we are today. And if you go back to, I think, 1976, 77, that started to creep up above 5 to 1. So 5 debt to 1 income, $5 of debt to 1 income, dollar of income. And when it goes above 5, that's suggested to be an early warning of negative financial times ahead. And certainly, if you look back in 78, 79 and forward, that was a pretty bleak time in agriculture, and that ratio was way out of whack. Then for 30 years, we've been below 4, generally speaking, until 2016, where it went back up above 5. And a lot of news media in the ag space were saying, ooh, that's a warning sign. We could be going back to the late 1970s. Now, the nice thing is we've trended downward. Farm incomes have come up. A lot of that is subsidized by the government, but we've seen farm incomes come up, and debt, while working up, has not gone up as much. So that ratio has improved back to where today it's at a relatively safe number. Here is the share of farm real estate loans that are delinquent. I would suggest to you both, this is farm real estate loans. The next one is non-real estate. And you can see that they are right at the average. It's been above and below the last 20 years, 30 years, but right now we're back at average. And here's the non-real estate loans, and again, right at average. And keep in mind, these are 2% of total loans. So we're not talking about a big number anyway. And so not really concerning in terms of any delinquencies. Here's the volume of delinquent farm real estate loans, about $2.25 billion in a multi-trillion-dollar industry. Again, not real concerning. Here's the one number that has been a concern and could be a problem, except we got higher commodity prices the last 6-8 months, and that's really helping work this working capital number back up. But go back to 12, came through that golden era in agriculture, and that built up a lot of cash on the farm. So working capital numbers were extremely good at 37%. Then we started to see farm incomes fall, and certainly working capital fell with them. And we ended up at 12% in the fiscal year 2020. I would argue that number is going to pop back up in 2021 due to better commodity prices and the government support payments that we've received. So that's improving today, and one of the reasons for the bullishness in land values. Here's real working capital, so inflation adjusted. When you compare it back, and certainly back there in the golden era, that was a much better time frame from a cash standpoint than where we've been the last 5 or 6 years, and therefore why we've been in a very flat sideways market. Here's a bankruptcy slide, and I'll start at the bottom and then work back up. 1987, I started in the business in 1988. In 1987, there were almost 6,000 Chapter 12 filings across the United States. In 2008, there were 250. 2008 was a pretty good ag year, even though the big recession started then. But from an agriculture standpoint, that was not a bad year. And we doubled those from 250 to 500 in 2018. Still, you're not even to 10% yet at that time of what they were in the 1980s. Jumped up to 627 in 2019 and then dropped back to 552 in 2020. So those government support payments, higher commodity prices combined with some pretty good yields year over year have led to that. And the number of Chapter 12 filings, while higher than 2008, aren't anywhere to where they were back in the 1980s. So keep them in perspective. So where do values go from here? I've always argued that it really depends on these three things. There are other factors, but these are the three majority factors. Farm incomes, what's it going to make this year? $900 to $1,000 an acre gross. Interest rates, and then supply of farms for sale. So we had that golden era of 07 to 13, generated a lot of cash. We had the cash drain from 14 to 19. And then we started to see market facilitation payments, pretty good yields, opportunities each year to sell above $4 in corn and above $10 in soybeans. And so you put all that together, 2020 and 2021 ended up being better cash years. Interest rates are still historically low. And then the farms for sale are basically 3/4 of the typical 2% that sell every year. So a lot of bullish information on that page. Here's the farm income discussion. Farm incomes, are they going to be $900 to $1,000 an acre gross? That's certainly potential this year. It wouldn't take 450 times 200 bushel corn. That's $900. That's achievable today on the board. So could you hit that kind of per acre gross? Your production costs, as estimated by our staff for corn, somewhere 700 to 740. Maybe even if you're a high cost producer, you're up at 800, you're still profitable at 900. And if soybeans, obviously you can do the math on that on your own, but you can kind of see some numbers there that give you an idea where some production costs are today and break evens. What does this mean? If there's that kind of profitability that exists in agriculture, rents are probably going to be under pressure upward because of more demand. And so that is certainly something to watch as we go into the fall negotiation season. What's interesting is a lot of rents were negotiated in October or November of 2020, 2021, and they were negotiated probably at lower levels than what they would be if they were negotiated today, because we've seen a big increase in corn and soybean prices over the last few months. And then now that we know what the February price is for crop insurance, that I think would probably argue for higher rents for 2021 than what they really are. So my warning would be to farm producers out there, and the upside to landowners is that probably rents will be under some pressure to go up because there will be more demand from farmers to grow and expand. So net farm income as estimated by USDA, you can see that peak back there during the golden era as we spoke of, then that really flat sideways channel. And now we bumped back up last year with an expected decline this year. That expected decline is solely the fact that government program payments are expected to really drop off. And I wouldn't expect to receive much. I think if they support crop insurance, which they certainly are helping subsidize, and if they remain as the floor through the PLC or ARC programs, that's really all you're probably going to expect to get here in 2021, beyond the authorized program payments there at the end of the year by President Trump. So let's talk about the impact of USDA payments. I've talked about that for a few slides now. Here are inflation-adjusted program payments from the government, 1970 to 2020. And last year was the highest ever, inflation adjusted. What does it mean in terms of income? Well, the total bar here is the farm income. Look at 2020 and then the big segment of that is orange, which are farm direct payments. So you can see that really without government support, we probably don't have as big an income year by any means, and pretty flat compared to the previous four. Here it is when you take out the government program payments. This is inflation adjusted. So it actually shows a downward trend in net cash farm income when the government program payments are taken out. Now, odds are that that probably jumps back up a little bit due to higher commodity prices here in 2021. But this really gives you an impact of those payments. It's been very supportive, not only for agriculture, but also for the general economy, certainly. Now, I mentioned earlier that Northeast Indiana has a lot of hardwood timber, and it is a factor in rural values, whether it be farmland or timberland. And so I just clipped these two slides out of the Indiana Woodland newsletter. And you can see that they talk to foresters, consulting foresters who sell timber. And here are the average and median stumpage prices year over year. And the trend line here is certainly upward for hardwood timber. Again, as the economy gets better, housing starts are up. You know, they're not putting hardwood timber into 2x4s. But certainly they factor into cabinets and furniture and those sorts of things. And so as a result, the average stumpage price is moving up. I would suggest to you this number could be quite a bit higher had it not been for the trade wars with China. China buys a lot of our hardwood timber, and that was an industry really hurt a lot by those tariffs. Here's the Indiana Farmland Cap Rate. Now, why would I show this? You know, it kind of is hanging there at 3% year over year. This is the cash return to your farmland asset. And you say, well, 3% isn't all that great. Compare it to the other fixed income alternatives. You don't compare it to the stock market. Farmland is compared to fixed incomes, which would be CDs, treasuries, those sorts of financial instruments, municipal bonds. And today, CD rates, treasuries are all at half or less than a farmland return at 3%. So farmland has a couple things that are interesting to that institutional investor. And there are certainly some institutional investors buying farmland. First of all, they like this better cash return than what they can get out of other fixed income. They also like the fact that it has upside appreciation, which averages around 4% a year over the long term. And then finally, farmland is an inflation hedge. And if you are subscribing to the theory that we're going to see some inflationary times in the near future due to all the government stimulus, then farmland is a place that some investors are going to want to have a percentage of their portfolio as an inflation hedge. So farmland leases, farmland is really what it earns. It's worth what it earns. I'm going to talk a little bit about consolidation because this factors into this. We know that consolidation in livestock is very well known. It's happened for years, decades. Consolidation in grains is also well underway. As evidence, back in 2002, 6.7% of the farms produced 75% of the total sales. Not really the 80-20 rule, more like the 5-75 rule. But 5.16% of the farms produced 75% of the total sales in 2017. Scale, that happens. Industries mature and farmers retire and other farms get bigger. So that's kind of reality. That's the way most industries go. What's interesting to me are the next couple of 3 points. First of all, the farms that produce 75% of those sales only own 37% of the equipment. I have after that. What does that mean? That means that those guys producing 25% of the sales own a lot of the equipment and probably are over-equipped. Now, if you get into the spring of 2019 and you need to be able to plant in a one-day time window, which is what we had back then, you need that equipment, right? But it certainly shows you the advantage large-scale producers have in terms of equipment. Organics. The largest 374 farms in the country, 43 had organic sales. That's more than 10% had organic sales. So really, are organics worth considering or not? Seems like some of the largest guys are doing it. And then the last point is expenses. And this is another scale evidence piece. Farms producing those 75% of sales did so on only 69% of the expenses. So they're able to buy their seed, fertilizer, pesticides, and those inputs at a lower price. So scale does have its benefits. I asked our staff just 2 weeks ago, cash rent results from 2020 to 2021, and the results of 21 cash rents, were they higher, lower, or steady? And you can see the results here. Again, that last point on the left-hand side of this slide, negotiated too early. I would make that as a point here, because I would argue that if these had all been negotiated in February or March, probably they all would have been in the category of higher. Would you lower any cash rents? And believe it or not, we had one of our staff lower cash rents, probably maybe on one farm. Supply and demand of farmland. So this first point is, what is the supply of farmland for rent? So how many acres are available to rent in 2021 versus 2020? And you can see that basically 2 said more, 3 said less, and 9 the same. So really not a lot of change there, pretty static year over year, which is what we normally see. But demand certainly higher, a lot more demand in 2021 versus the previous year. That stands to reason with the better commodity prices. Did you have any tenants default on leases? No. Did you have tenants give up their lease rather than renegotiate? Yes, we actually had 1 or 2 out of 600 farms do that. Cash flex leases. Will you try to implement more flex or hybrid or custom leases for 2021? 2 of our people said yes, 12 no. And that's really that last point. Many already are on a cash flex. We've used that for a lot of years. It is a great tool, especially for a year like this year. When you get into a really good income year, it gives that landowner a percentage of that extra income, and it doesn't require a whole bunch of fluctuation in that base rent. And so that's kind of nice. It mitigates some risk for the farm operator and gives that landowner upside, which is a positive. If you're curious about cash flex leasing, here are the base gross revenue numbers we use in our calculations, anywhere from 600 to 800 on corn, 375 to 600 on soybeans. Mid part of that range would be where you'd probably pick it. The base cash rent, did you change your base cash rents? 4 of our people said yes, they did. A little bit down, some up, but the average range is anywhere from $160 to $250 an acre, about 90% of fixed rent. So from a producer standpoint, they're paying 90% of what they would on a fixed rent as a guarantee. If it ends up being a good year, they might pay a bonus. If it ends up being a below average year, they don't. And so they have less at risk on the front end, and they give up some of the upside, but usually it's 25 to 33% of the upside if it's a good year. They retain the majority. Here's the Purdue survey on cash rents, and you can see optimism back in June. Again, this was a June survey, and there was a jump up in 2020 in all land classifications on rent, therefore driving land values. Now, compare this, because I mentioned this in yesterday's presentation. Look at the average rents in the state of Indiana, somewhere around $225 an acre for average land. Whereas the entire United States, this is the USDA survey, the average is right at $140 an acre for cropland, not range land, not pasture, this is cropland. So it just shows you Indiana's a pretty good spot to own farmland today, and this trend line is edging up, and I would say the 2020 numbers will be higher again. So here's my forecast as we start to wrap up. Long-term world demand fundamentals remain bullish for agriculture. Now, I've had this in my slides for 4 or 5 years, and people could sit there and say, yeah, well, when's it going to happen, Howard? When's it going to happen? You saw it happen this fall. It started with the derecho wind event and then Chinese buying. And that is evidence to me of that just-in-time delivery impacts. We don't have a storehouse of grain around the world today like we might have in previous decades. And so as a result, when the demand comes from, in this case, China, combined with demand from the rest of the globe, prices can shoot up pretty quickly. Interest rates still very favorable. 4.1% real estate mortgages, that's 15-year fixed money in the 7th district. That's the lowest in recorded history of that survey. I think that's really the point here. Not so much what the numbers are, but that's the lowest in recorded history. So evidence that the mortgage rates are pretty cheap. Supply of farms for sale remains low and lower for now. Starting to see some sales pick up here in March and April, but really January and February were pretty quiet. Government support in 2021. Okay, there's been one payment at least authorized from a support standpoint. Will there be more? I bet not. And then is it cash increasing? And yes, I think it probably is. So cropland values are certainly in an uptrend, and I believe that continues this year. If I was going to forecast, I could see values go up another 5, maybe even 10%. It really depends on where you are, but if the market remains tight and commodity prices are where they are today or even a little bit less, and interest rates remain steady, you're looking at a pretty dynamic market that could move upward. We also see strength in timber, recreational land, and rural residential land, as long as, again, low interest rates and that impetus for people to move out of cities. The one concern, if you wanted to have any, would be this average to below average farmland or hassle farms that are still less desirable. And as farms get bigger, one of the things that a farmer has a challenge with is farming really small fields. And so those are probably going to continue to lag a little bit in terms of value increases. So where do we go from here? I'm going to emphasize the bullish side because I believe that's where we're headed this year. You got profitable prices, you have a low amount of debt to assets, you have low interest rates, low supply of farms for sale. Those are all bullish. And you think about my 3 reasons why farmland moves, those are all positive factors. Now, biofuels, demand is steady today. It's kind of been lower, 10% lower than a year ago, but certainly steady. And this administration is going to probably be favorable to biofuels. What's the black swan event in the future? And that's electric vehicles. And now that's a little further down the road, but that biofuels industry, that'll be worth watching 5 years out at this point. World population growth, it can be an impact. Trade deals certainly help. The phase 1 China deal has really helped. Potential for inflation, that's going to influence some people to invest in farmland. And then that water resources and competition, always a good spot to be where you have plenty of rainfall at the right times. The bears, again, I'm going to minimize this slide, but these things could happen. What happens if we get these COVID variants coming back and it leads to more shutdowns? That could have a negative impact on prices and demand. Weather impacts always could creep its ugly head. You never know what the weather's going to be. I think if you look across the Corn Belt right now, a majority of the states are in some form of drought or abnormally dry. That's very unusual in March. That harkens me back to 2012. So something worth watching. Trade could be a big issue. Hopefully we continue to negotiate positive trade agreements. US and global production becomes too much. Brazil right now is trying to stimulate corn production. I think you're going to see more, high prices generate more production, and that's what's going to happen. Will that lead to lower commodity prices? What happens if you increase production in the face of a world economy tanking with lower demand? So these are some things that could happen. Interest rates could certainly increase due to inflationary concerns. The Treasury yield has gone up. The yield curve has really steepened. So you could see some interest rate creep here in the near term as well as long term. So all these things are worth watching. But I would say for 2021, they're going to be less of an impact than the bullish side. And then, if interest rates go up, things that you got to remember is that there are choices out there for that investor. And if they want to invest in the stock market or treasuries or CDs because interest rates have come up, that can take money away from the farmland space. Working capital remains a concern. It might be over for this year, but it could certainly come back if we experience negative incomes in the next few years. So I look at it and say we've got bullish fundamentals. Higher prices, that equals more demand for rental land, and that equals higher land values. And at the end of the day, that's through my 30 years of doing this, that's what we've experienced. So with that, Nolan, do we have any questions that have come in so far?
Yes, we do. So we got one that said the level of stimulus bills would suggest that we are in for an inflation level not seen since the 1980s. What are your thoughts regarding land values as we potentially return to Carter era interest rates?
Great question. We talked about that in a couple of different ways. One, if you look at inflation as it's correlated to farmland values, farmland correlates positively to inflation, meaning that when you get more inflation, real assets tend to be a place people like to put their money. And as a result, farmland values work up during inflationary time periods. Now, that high interest rate environment, I showed the slide back there in the middle of the deck where we have pretty high debt. And if you see interest rates shoot way back up, that could be a negative to farmland. Obviously, the costs of borrowing money go up. Now, one big difference to the 1980s, though, is a lot of those mortgage instruments were variable rate. And I would argue a lot of the ones being put in place today are fixed rate. So even if interest rates shot up to 10%, you're probably not going to see these mortgages change a lot from the levels they're at. I'm going to keep mine at the 4% level or whatever they are today. So that is something that I think has less of an impact than it probably had in the 1980s, but it certainly would have a negative impact because the cost of borrowing money is going to go up a lot. It also would have a very negative impact on the federal government, who has more debt than any of us. So I think, Nolan, those are the couple of thoughts on inflation and interest rates. I don't know that is, it's positive long term, but certainly it would have some positive impact on land values near term.
That's the only question I have.
Okay. So with that, I think we're ready to turn it over to Mr. Needler. Bill is he is market president for the Wabash area for First Merchants Bank. And we're very pleased to be able to share this presentation time with him. And at this point, I'm going to turn it over to you, Bill, to talk about some ag lending trends and tools.
Well, awesome. Howard, can you hear
the screen if you want?
Okay, Howard, can you hear me okay? Howard, can you hear me?
We can hear you now.
Okay, awesome. So first, thanks Howard and Rick and John and Neil for asking me to participate today. It's quite an honor to be here. I wanted to just keep the momentum going from what you were previously talking about, Howard. So while you were going, I completely reshuffled my deck of slides today because I think, you know, we were talking just here at the end about interest rates and those impacts that we see coming. And so I'm going to share, give me just a second to get this working. Okay, can you see my screen now? Howard?
Yeah, we can see your screen, Bill.
Okay, awesome. It's just a little slow, so give it just a second. There we go. How's that?
Perfect. Looks good.
Great. Okay. So we talked about interest rates and inflation and all these different factors that are affecting us right now, and kind of flip me back to in the early 2000s, when Donald Rumsfeld was the Secretary of Defense, and he came up with a quote as they were looking for weapons of mass destruction in Iraq, and he talked about there are known knowns, which are things that we know. There are known unknowns. Those are the things that we don't know, but there also are unknown unknowns, and those are the things we do not know, we don't know. And as I look at where we're headed here in the future, you know, the unknown unknowns are the things that tend to derail us. So, you know, if we look at interest rates, you know, where we've been, where are we now, where are we going, and what's your strategy, and how do we protect ourselves in financing to, you know, to structure deals with those unknown unknowns that are out there lurking. So you were talking about interest rates and those things. I went back and pulled a chart, Howard, from several years. So going back and looking from the 1980s to 2020, you know, 40-year span of rate. What's that chart telling us, right? 10-year constant maturity treasuries were trading somewhere around 15% in the early 1980s. And today those are less than 2.5%. The trend for fixed rate deals has just been downward for the last 40 years of time. If we take a look at the short-term cost of money, and I didn't trend this quite back as far, but the general cost of money on a short term, and I use the 1-month LIBOR as our indicator here, but you can see basically the cost of debt, even on the short term side, has been low for a long period of time. We did see some rise here in 2017 through 2020. You were talking a little bit about the inflation rate. Typically, when inflation rate approaches up to that 2% number, that's when we start to see those rises in interest rates. So we saw that kind of happen here in the 2017, 18, 19 period. And then of course, when 2020 came and we had a pandemic, inflation rate dropped well below 1%. So we've seen those rates drop. And then also they were, you know, artificially stimulated too, just to get our economy going. But if we kind of look at this 10-year history for recent, we see we've been trading in this sideways pattern for the longer term cost of money, somewhere in that 3.5% to 1.5% range. And of course, obviously, it trailed down here towards the end. Interesting, Howard, you were talking about cost of debt being around 4%, 4.1, I think is where you had it actually pegged in there. And I would say that's, you know, as we look to today in the marketplace, One of the challenges we have is trying to figure out, well, where is the right place to put that stake in the ground for financing an acre of ground? Selling price, last week, a little over $8,000 an acre. But when you think about what's the capacity of that farm to generate profitability and repay that debt, I would advocate, given current interest rate trends and the pressure of those potentially going up, that looking at financing a property somewhere in a debt per acre range, as opposed to 75% of its sale price, seems to have more merit as we look out into the future. And it at a $3,500 to $4,000 debt per acre, with 4% interest rates on a 30-year mortgage, that puts your principal and interest rates, principal and interest cost at a 4% rate somewhere in that $200 to $230 an acre cost. So relatively to cash rent, take away a little bit of money for taxes, insurance, return to management, somewhere around that $3,500 to $4,000 an acre financing seems to be a good safe place right now, for at least if I was going to make some suggestions on how to structure those types of deals, whether you were a row crop farmer or a farmland investor, that setting that farm up as a self-liquidating debt at those type of levels seem to be a great place to put them here as we look at it in the future, and particularly if there's a potential for interest rates to rise with the pressure of inflation here in the future. A couple other things I want to share a little bit about, and then I have about 4 or 5 takeaways here at the end. But one of the things that I wanted to talk a little bit about is just creating a relationship with lenders and being able to talk and discuss those types of strategies. The basics for that kind of go back to creating financial statements and having a baseline of information that you can look and work with your lender on. That format, typically we like to see some consistency and accuracy in the detail, doing some pre-planning before the year end, and also doing some planning for that throughout the year. Bankers love having those conversations throughout the year and getting teed up for that next purchase or that next activity that you may have. Through that process too, we can identify some key ratios that are important to to your financial performance, and more importantly, important to you what your goals are. You had mentioned, Howard, a little bit about the working capital piece as far as a function of gross margin, and I think that's just one of the key ratios. You like to see that somewhere around a 15% level or greater. I think the slide that you showed was somewhere around a range of a high of about 37 down to a low of about 12%. So like you, I think working capital is a little bit of concern. I think we're going to build that up a little bit this year based on some of the profitability that we've seen. But we also tend to have a propensity to erode that throughout growth and expansion. So if I had to put a target out there for working capital trends, I would say keep that working capital level somewhere around 15% of your gross revenues. Trend comparisons, I think, are excellent for us to have year after year. Another suggestion I would have with you working with your banker is have a peer group comparison. You can do that through a lot of different ways. One of them is Farm Financial Standards. They have that Sweet 16 ratios a lot of people look at, and you can key in on the ones that are important for you based on where you are and what your plans, and are you going to grow, are you going to expand, or is it a contraction? Are you eventually going to be looking at succession planning? So how you structure that plan and where you structure those ratios kind of become a little bit customized based on what your direction is. Sharing with you a slide here on just some ideas when you and your banker are having some conversations about where those key points might be. Again, liquidity, working capital, some solvency ratios on the balance sheet side, return to your assets and equity. We're seeing good strength in the balance sheet right now. We've seen some erosion off the profit and loss side over the years, the previous years, but depending on where you were on marketing grain towards the end of 2020, you might have had that potential for capturing that rise in grain commodity prices that we saw in December and January. And those gave a nice boost to some folks on their balance sheet and in their working capital position. But operations are different. Again, I'd say sit down with your banker, look at the different goals that you have, try to structure your goals on your balance sheet and profit and loss statement based on what direction you're trying to take your operation. Obviously, if you're trying to grow your operation, you want to build some of that working capital up. So when that opportunity comes to buy that farm or that asset that's next to you, you've got some cash in there to put down. Again, you think about that $8,000 an acre farmland that's sold. If a safe place for that to be financed is $4,000 debt per acre, you're looking at a downstroke. $4,000 an acre based on number of acres can be pretty significant. So again, that working capital position is critical for a lot of folks in expansion mode. I touched on some of these things here already about capital being, I haven't really talked much about capital being a barrier, but again, I think when you think from the expansion side, or adding a farm, definitely having some cash and capital reserve is something that we need to be able to tap into a balance sheet, whether that's on the working capital side or whether that's in other assets. One other of those, something else that I wanted to share a little bit about what's happening with our customers in the market space. We're seeing fraud and email breaches and those kind of events that are happening more and more frequently with our customer base. 4 out of 5 businesses in 2020 were impacted by some type of fraud attempt. And I think my concern with that is we tend to feel like we're a little isolated in the agricultural space, but more and more people are doing things online. We're sending more things by email. We're sending more things with ACHs and wire transfers, and being proactive on measures that can help protect the safety of your emails and your banking information is just really becoming more heightened. I have some suggestions here on how to mitigate some of those potential breaches, but probably of all these items, the biggest thing that I could suggest is just monitor your activity. And when you do have a breach of your data, reach out to your banker. I mean, we've done a lot of work to help train and educate our businesses to how to set up the right type of online banking structures. And then once those fraud things occur, then we work with folks to try to figure out how to recover what we can, but then set up different kind of passwords and backup procedures that can help. Another thing that a lot of our folks are looking at today is even adding insurance, for ransomware and those types of things into their normal farm policies. So the key takeaways that I wanted to share today are really, I look for a relationship with the lender, not just a transaction. keep reviewing your plans and progress is needed throughout that business cycle. Have those performance checkups. Keep an eye on inflation. I think that's the key driver for what's going to happen with interest rates in the future. Think in terms of structuring those farm deals as a self-liquidating type of structure. That $3,500 to $4,000 an acre debt is a safe place given that 4% interest rate and current returns to farming, as well as the current returns for cash rent. And again, be proactive and mindful of the activities that are going on with fraudsters and bad actors and how they're trying to hack into your database and compromise your emails and your banking information. I'm going to stop there, Howard.
Yes, Bill. Thank you so much, Bill, and we really appreciate your insights on the ag lending world. What questions does anyone have for Bill? We did have a question come in while you were speaking, Mr. Needler, that asked about how do you classify farms as small, medium, or large? I gave my estimates in the chat. I'm wondering what you would think from a lender's perspective. What do you think is a small farm? What's a medium farm? What's a large farm today? Row crop only, not including livestock.
Yeah, so great question. There seems to be a lot of synergies that are created with operations that are 5,000 acres or greater, some efficiencies. I would say that 500 acres to 5,000 is kind of that medium-sized farm, and I know that's pretty wide. And then I'd say 500 acres or less would tend to track me towards the smaller end. Yep.
Great, and I was very close to that. I had mid-size being 2,500 acres. And yeah, you'll see a lot of producers are in that 2 to 3,000 range. They want to grow more. They've got enough equipment to handle more.
Right.
But they're constrained because they got to compete against those bigger guys. And from a cost standpoint, they may not be quite as efficient. And the small, 500 acres down, 1,000 acres and down, to me, those are folks that enjoy farming. They have the equipment, and they're completely happy making some income off of that, but they probably have off-farm income supplementing it, and that becomes pretty critical to the overall family living. But it's something they do, it's their lifestyle, and they probably grew up on that farm, and it's what Dad was farming in previous generations.
Right, it's a function largely of equipment, right? I mean, a combine can run so many acres, right? So what's its capacity, and do I need one, or do I need two, or do I need a half, right? So yeah, I would agree. Probably that mid range of 2,500 is kind of the middle of the road. But it does seem to be, to me, when we start getting over 5,000 acres, that we start gaining really exponential kind of efficiencies in operations.
Yeah, and I've said for years now that when you go from 5,000 to 10,000 acres, you're becoming a manufacturing facility at that point. And I think you mentally need to think about it that way. And you have departments. Maybe it's an HR department, maybe it's an equipment department, maybe it's an input procurement department. And those are different people. Might be the same person that does a couple of those functions, but they really specialize in those things. Whereas the farmer that's farming 2,000, 2,500 acres probably does all that. And so that's another one of the differences when you start to get to that larger scale is your paradigm shift, I think, to where you're manufacturing that ethanol, even though it's corn coming out of the field. And then how do you do that the most efficient way? So any other questions? Nolan, have you seen any others come in? All right.
Howard, I would be curious as to your opinions on the setting up a farm debt structure as that self-liquidating concept, similar to like you would like an investment real estate piece. We're going to go over here and build a strip mall or something over here, and we're going to have tenants within that. We set that unit up based on, you know, the rental income that's derived from that particular unit. When you think about farmland, is that $3,500 to $4,000 an acre debt structure seem about right to you?
Yeah, I think so. You know, my brother and I did something similar to that exercise earlier this year. And that really is where you need to be to cash flow. And if that's what the goal is to say, I'm going to invest in this piece of farmland and I want it to cash flow and pay its own way. You know, historically speaking, somewhere between 33% and 50% debt to equity or debt to asset value is probably about right to cash flow it. And that's a function of interest rate, and then obviously what you're buying and how many acres of cropland versus non-productive cropland. And so that it all is highly variable depending on the piece of land you're talking about. But yeah, it's somewhere in that, you know, 3,500 to 4,000 acres. If the farm's worth 8 or 9 today, then you're, you know, somewhere at 50% or a little less than.
Right. And again, that drain then on working capital when that 80 acres comes up for sale, and you've got to go tap your working capital for $4,000 an acre times the 80 acres, and still try to keep yourself in that range of 15% of your working capital compared to your gross margin for, you know, on a good, safe place to be on an ongoing operation.
Yeah, and I think that's a great point, Bill, because how do they come up with that 320,000?
Exactly.
In your example? And a couple of ways. One would be your working capital. One could be your operating line, which that's not ideal. A lot of farmers will tap into equity they have in other pieces of land.
Right.
And that's the worry, I think, in the ag lending world is that are we layering debt on farms that don't have any debt? And all of a sudden we put 2 pieces at risk. And so that I've heard some other lenders say that would be their concern. Now, it all depends on the debt levels and their ability to cash flow it. And I think that's a different in mindset in the ag lending world, what it was in the early 80s, late 70s, where that was asset-based lending. And today, everything is much more cash flow lending. And can they repay that debt? Not so much what it is, but just can they cash flow it? And stress testing it. And saying, you know, can you cash flow it at $3.50 corn or can cash flow it at only $5 corn? And really that becomes the measurement as opposed to just purely, well, what's the farm worth and how much are we lending?
Right. I would advocate that I think a good safe range for balance sheets is that debt to asset or leverage position that would range somewhere in that 30 to 50% category most of the time. You like to get, you know, you're going to get towards 50% when you expand, but the goal is to then, you know, pay that debt down and get down to a lower level and then expand back up to that. It seems like historically when we see operations that get leverage in excess of 50%, those are the ones that when the unknown unknowns come about, that they become more susceptible to that stress, and their probability of recovery becomes lessened. So the safe range to play, I think, is somewhere, you know, you need to have some level of debt in your balance sheet, right? Just because it helps the return on equity and you know, your capital, right? If you're going to maximize your balance sheet, you want to have some level of debt. 30% or less, but when you're playing in that range between 30 and 50, that seems to be a good place for most operations today.
Yeah, I think that's a fantastic point, Bill, and producers can really grab onto that because I would agree. The ones that you see at risk are the ones that go above 50%.
Yep,
and it becomes a struggle every year just to cash flow it. Another way to look at it is how the institutional world looks at it. And a lot of times they have equity out the ears. So they don't, you know, it's not that they have to borrow the money to buy a farm. Why would they even incur debt? Well, they would incur debt if it enhances the internal rate of return. The only way you grow your internal rate of return through the use of leverage is if the return on the money is more than what the cost of borrowing it is. And so a lot of times we'll see that institutional investor buy the farmland with equity and not use any debt. And then they use the debt to do tile drainage, or they use the debt to build grain storage, or they use the debt to irrigate the property. And they do it to improve the property, which tends to have a 10% kind of return to it. And so as a result, it's hard to borrow money at 4% and have it return 3%. That doesn't enhance your internal rate of return. However, if, Bill, you're only borrowing 30% at 4%, that number is 1.2%, and you're making 3%,
right,
then it does enhance your internal rate of return. Right. So, yeah, there's a lot of ways to look at that and that debt structure, but I think you make a really good point. Staying in that 30 range is optimal, because you should use some leverage, probably, especially at these low interest rates. But when you get above 50, it's risky.
Okay. And Howard, I think that's one of the things as from a banker's perspective is I like having those kind of conversations. And I think we all need to do a better job of having those conversations with our customers and our clients and to have that dialogue and share that
information.
I think that's what strengthens that relationship, but it's also what helps us plan and forecast for our customers to keep them in the right lanes going forward. So I would just suggest that to anyone who's on the call, whether you're looking at it from an investment real estate piece or from an owner operator perspective, have that conversation with your banker. Have your banker hand you the analysis that they do every year and look at those numbers and talk through them just like we're talking through them here and have that direction setting plan between the two of you. I think it's really important.
Well, ag lending is so relationship based. And I made this point in our seminar yesterday that ag lending is unique. We deal with risks in agriculture, risks of weather and markets that we cannot control. A manufacturing facility has a lot more control because it's a controlled atmosphere inside the plant, right? And there's things they can't control, but they have a much higher degree of control than what producers do. And the key is having that relationship with your ag banker who understands that, there's going to be some tough weather years. And yes, there's going to be some times that maybe I don't make the return that I projected, but there's a long-term relationship and a history that allows that ag lender to extend them another year. And that's, I think, absolutely critical when you look at developing a relationship in your farm operation is having that great relationship with your banker, who many people are like you in the ag world that have a degree of expertise and a long history, and you can bring a lot of financial suggestions and ideas to that farm operation that can help them, and it lessens what they need to know. Use their banker as as an advisor in addition to just a source of money.
Yeah, and it's not just a source of money, right? I mean, I'm part of First Merchants Bank. I'm part of a select ag group that works with clients and agribusinesses as well as farmland investors across the northern part of Indiana. There's 3 of us up in Northeast Indiana that are great resources for that. But it's not just about loans and as a part of it, right? Because as a banker, we bring deposits, we bring private wealth, we bring treasury management. So there's a whole bank philosophy here of things that we can bring to a customer that helps build a plan as opposed to just a piece of that transactions. So that's why I would advocate to have that discussion, because it's not just the loan. It's having a plan, and how do you if your plan is to transition your operation from one generation to the next, how do you work with that and all the different facets of that? Because as it transitions from one to the next and that wealth is transferred, then what does that generation that gets the wealth do with that money in order to preserve that and maximize the best return that they can get out of it?
Well, I think that brings up another point that I failed to make earlier. For landowners out there on this call, one of the things to watch going forward is what does this administration, what does this Congress do with taxes? because certainly there has been talk about increasing taxes, the need to increase taxes to pay for the debt that's been incurred. And so if they increase capital gains taxes, what is the impact on farmland as a result of that? If capital gains taxes go from 20 to 28%, which is what they were previously, well, do I want to sell my farm now here in 2021 when I know that I got that lower capital gains tax rate? Or do I wait and maybe values go up, but I pay the higher capital gains tax rate? So that's a decision facing some landowners who might be thinking about selling in the next 2 to 3 years. And you might want to sell earlier as opposed to later because of potential capital gains tax increases. Now, to your point, you're talking about generational transfer. Well, one of the costs in that potentially is estate tax. And today the estate tax exemption is 11 million per person.
Right.
Well, mom and dad could have 22 million that they could pass to the next generation if they structure things properly, So that advocates for needing to do the planning in advance. But if that number goes from 11 million down to 5 million per, just picking a number, but if it gets reduced, then you could see a lot of farms that all of a sudden are a taxable consequence from an estate tax standpoint, unless they do a lot of planning. And that's to your point, where are those resources they can capture some help in how to structure things from an ownership standpoint, generational giving, and some of those things that you can do to make sure the farm stays in the family long term, and it does not have to be sold in part or in total just to pay the estate tax. And so those are a couple things I think that bear watching over the next few months as Congress gets its arms around COVID and some other things, and they start to look at any kind of tax changes. I think estate tax and capital gains tax are two that will impact ag as much as any. Any other questions, Nolan? All right. Well, hey, we appreciate everybody joining us today. And again, thank you, Bill, and thank you, First Merchants, for joining with us in this seminar. We just wish everyone the best in 2021 for a great season. And hopefully spring gets underway from a planning standpoint here in another month or so, and we can have a great production year. So we wish you the best. And if you have any questions, don't hesitate to reach out to Halderman or to First Merchants. We'll be glad to help you navigate the challenges that exist out there. Have a great rest of your day and a great rest of your week. Bye, everybody.